the way I look at it, they took what should have been a shot of adrenaline, turned it into an IV, because the last 10 years, that's what we've had, was we've had cheap money. And unless we're going to end up like Japan did many decades of having flat growth, we're going to have to start rewarding savers and not penalizing them like we are. Because it was nothing for me to talk to clients who are near or in retirement who had, in 2008, $500,000 in 5% CDs. And they had that safe. They, were getting 25 grand a year or so in income, and they were happy. Well, you can't do that now. And so they've got to take on risk that they normally wouldn't take on to get the yield they're looking for. And that's changing the paradigm of the market that I think people need to adjust their investment strategies for.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at stbullion.com. Now enjoy this interview. Welcome to this RTD interview. Today I'm excited to have first-time guest, Mr. Brad Williams. He's the founder of Brad Williams Financial Services. He's been in the industry for 25 years, helping retirees and investors navigate their financial planning. So I'm excited to have Brad join us. So Brad, welcome to RTD.
Well, thank you for having me. I'm looking forward to talking to you.
Well, I appreciate you taking time. And so before we went live, I was referencing that you're located down south, straight down I-75, and I've yet to go down to that particular region, but definitely excited to find out more about what you do down there, as well as how you process all the things happening with this current financial reality we're in. So before we dive any further, can you give the audience a little bit of who you are and how you've arrived at this point in your career?
Well, I'm a retirement advisor, financial advisor, and my specialty is those who are at or near retirement. So I'm more of a defensive type advisor. When people go from the growth phase to the distribution phase, that's where I come in, is showing them how to change that paradigm from the growth phase of their life to the distribution phase of their life.
All right. Sounds good. So I appreciate you for sharing that. So very first question, I'm curious. And so as you're helping people transition, I know for a fact you keep an eye on all the events going on around us, because I'm assuming you have to formulate strategize, and things like that around current environment.
Exactly.
And so at this current moment, what are some things that has you concerned that probably has led you to have to adjust your plans a little bit and help other people navigate as well?
Well, the continued environment of low interest rates presents a lot of issues for retirees who are on fixed income. And the fact that so many people use bond funds to have a defensive part of their portfolio, and bond funds do not perform well as interest rates start rising. So we're kind of at the bottom. I mean, when you look at the 10-year Treasury, is hovering around 1.5 to 1.6%, when the average is typically 4.5%, with the exception of the late 70s, when it got up into 15 at range, which was, an anomaly. But looking at how the Fed's handling things, there is an awful lot of liquidity, and what concerns me is the national debt, and pretty soon our trading partners justifiably will start demanding a higher return for the risks they're taking if we don't continue, or if we don't stop, spending more money than we bring in.
Interesting. So one thing I want to touch on, you mentioned the lower interest rates. And so I myself, I'm part of the younger side of things, as far as in the millennial, right outside the millennial time frame there. And so you've had a chance to witness the impacts of monetary policy for probably a few decades as an investor, as well as someone who helps people strategize. And so clearly monetary policy plays a major role in everything moving forward. And so with interest rates being the way that they are now, we're less than 2%, or I think 1.25%, give or take, whatever it might be, or be readjusted to. And so for you personally, how do you make sense of where we're at and possibly plan or strategize on where this could be heading within just this year alone?
Well, the stock market continues to rise, and the last 10 years have been a great time to be in the stock market. But I would say that that's largely been driven by zero rate interests, low cost money. And if you look back at 2018, as the Fed started raising rates and signaling more rate increases to come, if you remember back October, November, December, the market crashed. And then the Fed comes back and says, whoa, 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 wait a minute, maybe we're not going to do that. And then Wall Street got excited because they were going to get more of their free money again. So what concerns me about people who are heavily in the market, who are near retirement, is that if we have another one of those 50% corrections like in 2000, 2003, and 60% correction like in 2008, 2009, some of these people may never recover. And so shifting into the income phase and looking at income generating securities and investments and away from the growth phase. I'm not saying they should be out of growth, but you've got to make that paradigm shift from the accumulation stage to the distribution stage, and those are my concerns.
Right. So you hinted at two very interesting time points. We had the .com, and then we had the great financial crisis, of which the markets responded with some type of severe correction. And so given the fact that we've been 10 years plus now in an environment where monetary policy has, I would imagine, propped things up and kept things going a little longer than naturally would occur, what's the likelihood, in your personal opinion, of this next correction being much more severe than the prior two that we have as an example of what happens when things go a little bit haywire?
Well, I think one example of that would be the 2018 fourth quarter. That shows you what can happen. I think so many people, so many big money people are sitting on a hair trigger, and they're just waiting for that because they know, we're 10 years into a rising stock market, and that's not usual. And what in 2008, when the market crashed and the economy crashed due to the mortgage bubble and all that, the Fed did what they normally do. They inject liquidity in the system to pump prime it, to get it going again. But the way I look at it, they took what should have been a shot of adrenaline and turned it into an IV, because the last 10 years, that's what we've had cheap money. And unless we're going to end up like Japan did many decades of having flat growth, we're going to have to start rewarding savers and not penalizing them like we are, because it was nothing for me to talk to clients who are near or in retirement who had in 2008, $500,000 in 5% CDs, and they had that safe. They, were getting 25 grand a year or so in income, and they were happy. Well, you can't do that now. And so they've got to take on risk that they normally wouldn't take on to get the yield they're looking for. And that's changing the paradigm of the market that I think people need to adjust their investment strategies for.
Yeah, you mentioned risk. And so the longer this artificial nature of easy credit and money is, as you mentioned, is being pumped out there, the IV, as long as the IV continues to go on, doesn't it increase the risk exponentially of there being some type of event that could cause major issues that like we've never seen? And so a lot of people I've interviewed before, they always refer to the Great Depression as being a prolonged time period of just complete economic stalling of everything. And with that being the case, we had all types of executive orders, and and it created a whole new world order in a sense of how we view financing and investing. Could the possible risk that people could be exposed to now be that same type of paradigm shift as you hinted at?
Well, it could very well be. One thing about the Great Depression is we didn't have the kind of national debt that we have now with the kind of social programs that are unfunded. So that's uncharted territory. And so how is the government going to respond, if we have a major market correction? And I think after going through that twice in the last 20 years, that if it starts crashing hard, you're going to see a mass exodus from the stock market. And that could bring us lows that we hadn't seen in decades in the market. Now, I'm not saying that's going to happen, but there's only when you're the ammunition in your gun belt is low interest rates. Well, there's not a whole lot of bullets left in the holster for the Federal Reserve right now. Right. Rates are already very low. Were they going to go negative?
And that's the mystery of this monetary toolkit that Jerome Powell's referenced, that at this point, to save face and to keep everything quote unquote normal, I think they're open to anything. And so using the ECB as an example of what negative does to you, they're forcing the cost upon savers, as you hinted at. So creating an environment where you can save now in the ECB is not ideal because of negative interest rates. And so do you think as a response to some type of event, we'll have negative territory, or not QE become QE in a sense?
Well, I think the latter is probably the more, just printing more money. I don't know. Americans have a little different attitude than Europeans. And I don't know that America's retirees are going to stand for negative interest rates. Don't know they have much of a choice, but they're going to flood to whatever assets are going to give them the best return. I've always told my clients that money goes where it's most appreciated. Well, could that be gold? I mean, you hear all these people, I'm not a gold bug, but I have a little gold. Could that be the asset that people flee to? And if that's the case, then we could see a massive run up in the price of gold if they're going to be getting out of equities to do that. So there are alternatives, and I think I have a little a glass globe to my right over here on the credenza, and I always tell people that's the closest thing to a crystal ball I have. And it's kind of blue and dark, so I really can't see much in that. So there's all kinds of things that can happen, but I think a correction is got to happen because historically it's got to. Now, how long can the Fed keep it at bay? Well, they kept it at bay for several years now. I would have thought around 16 or 17 we would have had that correction, but it's been delayed. There's been some good public policy. There's been, the tax bill was good for business. It was good for my business. I mean, it reduced my taxes, gave me more spending money. So the business environment's positive. Money's coming back. So there's a lot of good things happening, but we cannot ignore the problems that government has created in things like, look at Illinois and California and a lot of these public pensions. You want to talk about consumer confidence, which is high right now. Well, you take away these city, state, and local workers' pensions or reduce them significantly, you're going to see a little change in confidence.
Yeah, that's true. And so that's one thing that I've kind of shifted the channel towards is the pension situation. And so I've interviewed a lot of people in the financial realm that help people navigate the storm that's underway. And so when it comes to pensions, I believe that there's already been a lot of theft taking place with pensions, whether it be the institutions not being able to properly manage funds, or there not being enough funds there. And so you got a public pension, you got private pensions. And so not too many people, the younger generation have that opportunity. So we have the 401k model. But from your standpoint, I'm assuming you deal with people who have pensions. And so you might have maybe perhaps a story or two you can share of someone that might had got some shocking news or something. And how did you probably navigate them through or help hopefully get them back on some type of track of sustainability?
Well, I had one client who was a pilot for a major airline that went bankrupt and had a significant drop in his pension. And that was a life changer. That pension he was counting on wasn't going to be there. The Pension Benefit and Guarantee Corporation kicked in. And that's really designed to help the lower and the lower middle employees retain what they have. If you're for example, in his case, if you're a captain on an airline and you got a high pension, well, you're not one of the ones that was designed to really protect, although you get some, form of protection. But and then you look at city and state and local pensions. The one thing about a private pension, although it's insured by, the government, is that, when you're dealing with a city pension, it's in state and local, it's coming out of the taxpayer dollars. And that taxpayer dollar is getting squeezed more and more. I mean, there are some horror stories of California pensions where you've got city workers that are getting $150,000, $200,000, $250,000, $300,000 pensions, and you just scratch your head and say, who promised them that? Somebody promised them that. And a lot of these pensions are using very, very optimistic actuarial assumptions to to be able to meet their obligations. Well, go back to the low interest rate environment. That's one of the problems with pensions right now, is the Fed keeping interest rates low is also creating a pension bubble.
Thanks for watching this interview. If you're enjoying content like this, feel free to become a part of the RTD community by becoming a member via Patreon. All it takes is a monthly contribution of about $5 a month for more great content such as this. Just scroll down beneath this video here and click the Patreon link, and then hit this tab right here to become a member of the team. Looking forward to bringing you more great content. Now, let's get back to this interview. Thanks.
Because they can't meet their expectations.
Yeah, I've saw several, having followed, I've actually, the PBGC, they post, I think since 2012, 2013, they post actual notification letters that they send out to, they're required, companies are required to post, to share information that they send out to their holders. So I've read through several dozen letters now, and I read the stories of, sorry, due to the fact we're less than 30-40% underfunded or whatever the bad news is, we might have to, within the next couple of months, the next couple of years, have to dial back. And so you mentioned the promises. And so it's one of the things where 10, 20, 30 years ago, when those promises were given, I'd imagine the people who gave those promises never took into fact that monetary policy would be at this point due to the nature of debt and our very monetary system itself. And so I kind of feel sympathetic for those that are expecting those promises to be fulfilled, but due to the environment, there will be a lot of broken promises. And so when it comes to the younger generation now being given 401ks, and I read the mainstream narrative, and so they mention about, they're not investing enough. And my question is, in an environment where printing and creating reserves will become abundant, how can you actually determine a number that might be sustainable to last you your length? If you were, say, 30 years old, 40 years old, how could you determine a number? So you deal primarily with people that's looking to get out and to start accumulating. For a young person, how can you begin planning when you have these environments type of stuff around you?
Well, I've got 4 children. I've got 2 daughters in their 20s and then 2 stepchildren in their teens. But my daughter's in their 20s. One of them works here with me. The other is got very successful with a business in Birmingham. And what her and her husband are doing is they're just saving everything they have. They're trying to pay off their house. She's learned a lot from me, and she graduated from Auburn with a degree in math. So, that says a lot about her. And she's a numbers cruncher. And so I'm real proud of her. She's working, even though she doesn't need to, an extra job to save money and invest it. And they're looking the long term. I think in the long term, stock market is still a good place to be long term. But since I deal with folks that are, 5 to 10 years prior to retirement or already in it, well, they don't have the time necessary to be able to handle the risk that brings them, and especially in today's market. So young people, what I'd say is just don't live for today, sock it away.
I like that. Now, as we draw, I don't want this interview to be like a doom and gloom. And so it's definitely things we should be aware of. And so you are currently helping people right now navigate. And so for those people that are looking to preserve their capital and find ways for it to grow, what are some strategies? What are some things, opinion-wise, that you might throw out there as being something worthy of looking into further that people can take a look at and probably consider?
Well, one thing is look at your I go through a process, and although I look at things in a realistic way, I'm not a doom and gloomer, and I'm not a negative person. There are ways you can navigate through whatever crisis we have if you have the right tools and the right attitude, because there's opportunities everywhere. There were plenty of millionaires made during the Great Depression.
Right.
And so even in the worst of times, there's opportunities if you're willing to step out of the box and look at things you're not used to. So one of the things the challenges I have with clients is getting them to adjust to the fact that, as I mentioned, the paradigm shift from the accumulation stage to the distribution stage, that they need to invest differently, that they need to invest for income. They need to look at dividends and interest and not so much growth. Growth is important long term, but looking at how much are they going to get out of their portfolio on a regular basis, even though the portfolio value might fluctuate, how to invest to make sure they're getting adequate dividends and interest to cover their required minimums and to cover their living expenses, in addition to either their pensions or Social Security, things like that.
Interesting. Now, if we were to be talking, so of course the information you provide is for clientele that's in the U.S. based upon the fact that we currently have the reserve currency. And so the name of the show is Rethinking the Dollar, because I like to go out ahead a little bit towards my latter years when I personally am not confident that the Federal Reserve note will be something of substantial value that I would even want to, base my life upon. And so a lot of the viewers here are heavy precious metal enthusiasts, because they've been characteristically known as money for quite some time and been a safe hedge against monetary policy. And so we're seeing a lot of that happening in Venezuela, Argentina, and all those other nations that the currencies are no longer of value. And so when it comes to preservation of wealth, long-term alternative strategies, you mentioned that, you got a little gold, but yet you're not a gold bug. But yet,
right.
Would you say that precious metals, gold, and maybe even real estate might be good options for people to consider, given the fact that at someday we might have a currency situation? And do you perhaps see a currency situation with this repo stuff going on, and not QE, but it is? And could there be a currency situation one day where perhaps, you might not want to be holding on to much of those Federal Reserve notes?
Well, there could very well be. I think one of the things that when we look at our trading partners and they hint and rumble about getting off the dollar, but I don't think they're in a big hurry to do that, because by being on the dollar, like it or not, we're the world's policeman. And the reason we can be the world's policeman is we're the reserve currency. So we have the money, even though we need to print it often, to be out there, to keep the sea lanes open, to be there to arbitrate certain issues that happen in different countries. And so there's a lot of reason why that our trading partners haven't pushed too hard, but there may come a time when they do. And when they want to trade oil and things like that in other currencies, Bitcoin or whatever, then we have a serious issue that we've got to deal with, because the printing presses are going to come to a grinding halt. And other countries have found that you can't just add zeros to the bill. I've got a Zimbabwe note that was given to me, an official one by, you've probably seen them.
Oh yeah, I have. I got the whole
$200 trillion or something.
Yeah, I got a whole collection.
Yeah, I bet. And I show that sometimes to people. I say, that history tells us that we're not guaranteed to be here forever. And so having alternative plans, precious metals, I think real estate is a great tool for generating income. If you do it right, you need to do it right. If you don't know how to do it, get with somebody who knows and learn from them, because that's an expensive mistake if you get out there and start buying the wrong properties. And I have a lot of my clients who are very wealthy and have great income. They get a good bit from even small scale rental properties. So real estate, they're not making any more of it. So real estate's a good investment tool. I think I look at precious metals as a hedge, not so much as an investment. That's that protects a certain amount of my currency if doomsday happens, or if some emergency happens in the country that, we have an interruption in the economy, and I have, those coins or whatever to take care of my family, So, if you're going to invest to make appreciation in precious metals, you're probably better off trading the paper and not the metal itself.
Yeah.
But, that's all a matter of opinion.
Right. Now, so as we get ready to draw towards the end of our discussion, you threw out a word there that I want to touch on, because I've witnessed as I call it, the evolution of our currency from metals to redeemable paper notes, and to solely paper to digital transactions and the like. And so you throw out the word Bitcoin. And so given the fact that you're into helping people that's looking to begin, transitioning out of the workforce into the afterlife of retirement, I'm assuming they're keeping an eye on this new technology. And so digital transactions is nothing new, but the way that's being branded in the form of digital currencies. Central banks are looking to roll out digital currencies, as well as this new alternative style called Bitcoin being the leading one. How has that been received amongst the retirees, and are they interested in doing it? And what would there be a learning curve for some, according to your interaction with them?
Well, I have very few clients that have any Bitcoin. A lot of them talk about it and they look at it, and it's like that car they're looking at that they're not sure they can afford. You know, they're just kind of looking at it, and they hear a lot of talk about it, but they haven't done anything about it yet. And I'm not a Bitcoin expert, and I tell them that when they ask me. I said that's not my realm. I'm not saying don't do it. I'm just saying that, you know, make sure you understand it when you do.
Yeah, understandable. So, Brad, it's been great having you here on RTD. For those that might want to, you know, follow your work and see more about your work, reach out to you. Can you point them back to your direction so they can be a blessing to you?
Yeah, they can visit my website. I always tell people if they've got a financial question, just ask bradwilliams.com. And that's my website, askbradwilliams.com. I've also got a weekly radio show that's local here, and I've got a website with all my past shows, the askbradshow.com. So just ask Brad.
All right, well, ask Brad. So, Brad, I appreciate you for joining us here on RTD. Looking forward to staying in touch with you, as well as hopefully get some ideas and strategies as we move forward. And so a good portion of my audience happen to be in that phase of life where they're looking to transition out. And so outside of me telling them to, you know, my motto here is get your weight up, as far as, you know, that the heavier you are, the less likely you are to be blown away when this monetary storm unravels, in my opinion. And so it's good to connect with. Thank you. It's good to connect with somebody who helps people more from a financial standpoint. And so I appreciate you taking time to join me here.
It's been a real pleasure. I've enjoyed it.
Thank you.